basically what I about group account is just the account of the parent and the subsidiary. So, and a parent company can be, let me just explain like this. A parent company is a company that is holding more than 50% of another company that has 50%, more than 50% of a share in another company. So that company is said to be a parent company, while the subsidiary is the company that the share is being held, like more than 50% share is being held by another company, by the parent company.
Okay, thank you very much for that. So what are your expectations from this class? We are going to be having like 6 classes. All of them will be on consolidated financial statements. What do you expect?
I expect we cover everything about the consolidated financial statement, the group account. I expect us to cover everything.
Okay, thank you. All right, you said everything. Okay, Babajide, you can go ahead and speak.
Okay, thank you, sir. Okay, so now let me just talk about my expectation. Okay, so I've discovered that in the last 2 diets, ICANN has kind of surprised the students, the candidates by asking questions on group cash flow, and in the last diet they asked questions on group retained earnings. And then from my experience, most tuition centers, what they teach is the group statement of financial position and group profit or loss. So I will want you, if possible, sir, if you can also touch on group cash flow and group retained earnings, because when I checked the syllabus, I discovered that it is that those topics are actually there, but unfortunately in the previous study pack they didn't include group cash flow and group retained earnings, but in the syllabus is there, so that's why they set questions on them. So please, so that's my expectation. Thank you, sir.
Thank you very much, Babajide. All right. Olorun, I didn't get to see the other part of the name. You can quickly speak while we go over. Okay, I don't know if he's there, if you can hear me. So the essence of me wanting you to speak, tell me about your expectations before we go into the classes. I want everybody to be settled and your mind is ready. I don't want it to be a robotic class. I want us to be able to interact. Now, today I have some PowerPoint presentation, though not very fine. If you at any point cannot see me, you could cannot see the screen, you can go over to the comment section and let me know. That in our presentation, we are looking at consolidated financial statements. Most old books could call it group accounts. In our class for today, we want to understand what the group structure is, learn how control affects consolidation, identify intercompany transactions, understand treatment of unrealized profits. When we have unrealized profits, either the parent is selling to the subsidiary or the subsidiary is selling to the parent. What do we do about it? Now, the second speaker had mentioned that we mostly focus on consolidated financial statement, P&L, and the statement of financial position. And most times, we don't talk about changes in equity. We don't talk about cash flows. That was what he said. If time permits, definitely we'll look at the whole of it. But if you have a good understanding of group accounts, P&L, balance sheet, and some other topics, regardless of what surprises ICANN might bring, you will be good enough to get a passing score or a beautiful score. But we'll try as much as possible to cover every areas that are important to you passing. Now, most times students tend to feel that we are too slow, we are not moving as fast as we want. what I would advise you to do is that try as much as possible to read your study pack. People abandon the study pack and they take too many materials. What I would advise you, do not include any additional material that this has to do with textbook. Your study pack, the Pathfinder, and videos online is enough. Do not complicate your study process by having different textbook. Because the more textbook you have, the more you need to read. And if you are working especially, you might not have the time to cover all of that. But the study pack is enough to explain things to you. Where you need more clarification, you can watch videos, short videos. Do not spend so much time reading textbook A, textbook B, and the rest. Try as much as possible to read less books, but try to get understanding. Maybe from short videos online. There are a lot of videos online. There are a lot of resources online. You could try to use them. When we talk about a parent is any company that controls one or more subsidiaries. They own up to 51% shares in that company. So if two companies are together and they have 50% shares, in that case, it is a joint partnership. But where you are, it's one company needs to have more shares compared to the other company before we can say the company is the parent of the other. Now, in most cases, 51% above is what we consider as parents. That's what a parent is. Now, the subsidiary is controlled by another entity or owns less than 50% shares. The reason we are saying, but it should be above 20 is that once it is less than 20%, we see it as a normal investment. It's not more of a subsidiary parent relationship. But what you should be more concerned about is if the parent should own more than 50%. And the reason for the specification that if you have less than 51%, it means you don't have control over that entity. You cannot control their strategy. You cannot control their profit. You cannot control how things are done in that entity. But whereby you have more than 50%, it means you are the majority shareholder. It means you can control what happens. Control is you can decide to a large extent what happens in the company, who becomes this, who becomes that, or what strategy should be employed. And that is what we mean by control. Influence over the activity, the operational activities, the financial activities of the company. That is what control is about. I don't like dwelling so much on the theoretical part, so I would leave that for you to read up and understand. All of this has been dropped on the group. You can go through them, try to get small understanding, read your study pack. For me, I would go to the core of our class. I always like to talk about some key things in financial reporting. Let me share class 1. I would always want to talk about, I call it, in accounting, we have what we call the big 4. Well, I prefer to say the big 5. Why am I saying big 5? Just your hands, 1, 2, 3, 4, 5. There are 5 important things you must understand if you want to solve consolidated financial statements. There is nothing in consolidated financial statement other than adding line by line. But the only thing that makes it complicated is you would need to understand some of the principles for you to be able to solve. That is one thing that most people get confused about. First of all, there is a law that says if I have any kind of transaction among ourselves, because the parent and the subsidiary, they are the same company, they are related company. Whatever related transactions, it should be identified and eliminated in full. And that is something you should have at the back of your mind. Any transaction that occurs between the parent and the subsidiary should be identified and eliminated. Eliminated means it should be written off, it should be taken out of the book. In most cases, you will see us try to subtract a particular number. In most cases, you will see us try to do things. It is this statement of mind that we have that is making us say, oh, you have to identify and eliminate whatever transaction that is intercompany in full. And that is the reason why we would identify those things and eliminate in full. As we walk through the class, for some of you, you already have read about this. Some of you know about it. I always would say the big 5 things, areas you must know in group accounts. One of the core things is the group structure. When we talk about the group structure, it's very, very important. Under the group structure, you must identify date of acquisition, of those in YouTube. Let me zoom it. Date of acquisition. Sometimes we just say DOA. Then you must, the date of consolidation. Sometimes we call it reporting date. Now, when you look at a question, you have to understand the day the parent acquired the subsidiary. That's the date of acquisition. Then the date of consolidation or the reporting date is the date that the account is being prepared, is the date that they will show you on the account. What I mean by the date that they will show you on the account, in any question about group accounts, they would give you an account, the account of the subsidiary, the account of the parent. They would give it to you so that you can work with it. The date in that account, the date that is showing in that account is the reporting date. The date of acquisition, in most cases, they will tell you in the additional statement, or they will tell you at the beginning of the question. But you need to understand what is the date of account. If a parent acquires 70% of the shares of the subsidiary, it means that the group structure will be 70 and 30. So it means that the parents, A has 70, the subsidiary has 30%. In most cases, they might not give you the shares of the subsidiary, they'll just talk about the shares of the parent. Once you are giving the shares of the parent, automatically you apply that to get whatever the subsidiary value is. Or they might give you the share numbers. What I mean by the shares number, if the total number of shares that B has is 10,000, if you are told that A has acquired 6,000 shares, automatically you would know that A has 60%, A has 60%, and B has 40%. So the group structure is 60-40. That is a very important thing you must know in group accounts. What is the group structure? It's important. That's the first thing to know. Once you are done with that, the next item you must understand is the net asset list of the subsidiary. When we say net asset list of the subsidiary, what are we talking about? We're talking about the items under the equity of the subsidiary and any additional information. Let me share a question that we can use to learn. So I'm going to the group to get the questions I shared there. I'm going to look at, I just want to pick an example from the questions. So what you could do, please try and get that copy of this so that you can follow. Because if you're looking at soft copy, maybe you might not be able to move as fast as there's this booklet they sell. You can try and get it so you can properly follow the class. I'm going to read a question to you. The essence of that question is just for us to get familiar with how the questions will look like and what you need to do. Let me share my screen again. So this is an ICANN question for May 2015. The question number 1 is, it says Unitarization PLC is a successful Nigerian company which recently amended its objectives. Those are grammars. The company therefore acquired 60% of the equity shares capital of Famous PLC. What is the group structure from here? Somebody should put on the notes. Anybody? All of you? What is the group structure from this question? The group structure. 60-40, 60-40. Yeah, that's good. 60-40. So that's it. In this question, it is specified that the parent has 60% of the equity shares of Famous. Now, before we go over to solve things, I want you to open your mind, especially for those that have done financial reporting before. You might feel like, oh, he's taking too much time. Let him go to the solving. The solving is very easy if you understand the principles, if you understand the language or the story around this. Look at this account. This account is not your regular account. But in this first page, what you can see on the screen is your profit or loss account. It might be very short, but that is what it is. You have the revenue, you have cost of sales, and the rest. That's your profit or loss account. It is statement of profit or loss and other comprehensive income for the year ended 31st October 2014. This is what I mean by your date, your reporting date, or your consolidated date. So we have seen that it is 31st of October 2014. If you look at the top, they did not specify yet at what date did you acquire 60%. Let's go downwards if it will mention. The shares of Famous PLC was acquired on 1st of May. So the first thing that should come to your mind is 1st of May 2014 is the date of acquisition. What is the reporting date? From what I've explained, what is the reporting date? The date of acquisition, we can all agree that the date of acquisition is 1st of May 2014. So what is the reporting date? Thirty-first October 2015. Yes, that's it. So the reporting date, like I said, is the date that you will see in the question. Look at the date here. This is the reporting date. Now, the first thing that should come to your mind is it a full year account you are dealing with, or you are dealing with a mid-year acquisition? Forget about the grammar, mid-year acquisition. Between this date that they are reporting and the date that the company was bought by you, how many months do we have? This is May 2014. This is October 2014. So, and here it is the first day of May. So, which means if you're counting, you have to include May. May is 1 month. June, July, August, September, October. It's a 6 months. Balance sheet shows balance. Most people don't get these things confused. Balance sheet will show you your balance. But statement of comprehensive income or your statement of profit and loss, it doesn't show you balance at a particular period. It shows you your account for a period, not balance as at today. If I show you your balance sheet, your cash balances, whatever is in your cash today would be what would have been in your cash as at the end of June. If you check it, you'll see it there. It shows you cash at a particular time. That's why they say statement of financial position. This is where you are. But your profit and loss account, it shows you for a period of 1 year, a period of 6 months. In most cases, profit or loss account is for a period of a year, 1 year. It means that this account you're seeing here, even though the statement of financial, the statement of profit or loss and other comprehensive income for the year ended 31st October, it is being presented on the 31st October 2014. This account is for a full year. So for that reason, you have to consider the period when you are consolidating. If I want to consolidate profit or loss, this 51 is for the parents. I will not add the full 25,200 to 51. I would only add 6 out of 12 to 51. That is when I am consolidating the financial, the statement of profit or loss correctly. You have to add it by the period. The only time you can add them line by line is when it's a full year acquisition, which means from the date the parent bought the company to the date they are reporting, it is 1 year. If it is not 1 year, you have to do pro rata for the subsidiary and add the figure to the parents. Of course, after you have identified all the related party transactions and you have eliminated in full. Now let's go over. If you're looking at this statement, there is always, you know that in real life, your revenue cannot be equal. You cannot say you would have revenue of 1,000 in January, 1,000 in February. It can be different. But for the case of solving in exams and ICANN, they always tell you that you should assume that this profit, this revenue, is equal across the 12 months. That is why we are going to take 6 out of 12. Because there's always that statement to tell you that, look at this statement here. You say, assume that the profit or loss accrued evenly over the period, except otherwise stated. So we are assuming that if I take 6 out of 12, it is the right proportion of revenue I've gotten. Now, this second part is your statement of profit or loss. This is the part for you. This is the part for famous. In your accounting, when you take your assets, your entire assets, and you take out the liability out of it, what would you have? When you take your entire assets and you take out your liability from it, what would you have? I've shared the question with you. Nobody should stress me to share any question again. Everybody should check it. I'm looking at the question 20. This is the question I'm looking at. So everybody is saying equity. I wanted people to say net assets. Is your net assets. And in this big five, we have said that the next item is the net asset list of the subsidiary. It means we are going to take into account the items under equity only. That's the net asset list. So which means, yeah, we'll be looking at your equity share, which is the 6,000, your retained earnings, which is 21. That is what we'll be working around. But there will be a little bit of adjusting, which you would learn as we progress in the class. The next item we need to look at after you have gotten your net asset list is your goodwill. Goodwill. What is goodwill? Goodwill is simply you take in what is the extra value a company is worth outside the company's net assets. That is what goodwill is. The value of a company outside its net asset, outside its physical asset, is the goodwill. Maybe the name of the company. This company has been existing for long. Because this company has been existing for long, I can't just say it is only the asset the company has that the company has. For the fact that the company already has people that trust in their brand, people that trust in the business, that is the goodwill of. So we have to understand what group structure is, what the net asset list, and I told you that the net asset list is more of, you look at what you have in your equity column and then your additional statements. Don't worry, we'll go over it, but I want to have an understanding. If I want to calculate my goodwill, the first thing that I must understand is my purchase consideration. But I said, what is goodwill? Goodwill, in most cases, by definition, in that note I've given you, I try to define what goodwill is. He said it is the excess of consideration over fair value of net assets. It is the excess of what you pay over the net assets. If you define it that way in your exam, it is fine. I have paid 10,000 naira to acquire a company. Yes, the question is on WhatsApp group. Just open it. The 2015 question is what I'm looking at. I'm using it as an example. Now, let's look at this example. I have used 10,000 naira to buy Famous Group. This 10,000 naira is what we call purchase consideration. If I pay 10,000 naira, by the time you add up all the assets the company has, you take out the liability the company has, it is 5,000. Now, this 10,000 I have, it gave me 70% of the shares of the values of the company. So there's a 30% that is not owned by me. There's a 30% that is not owned by me. This 30% is the NCI value. What is this NCI value worth? 30%. Let's just assume most times you have to, if you're using fair value to be given to you, let's assume the NCI value is worth 1,000. Or let's just say 2,000. How do I now know what the goodwill is? The goodwill is simply what your purchase consideration plus the NCI value, then less your net assets. So if I say equal to this plus this less the net assets, what I have now is my goodwill. Is the goodwill. So it means that, what does this mean? It means that the company is worth way more. What I have paid is quite higher than the physical assets. By the time you combine what my own portion of 70% and 30%, and I paid 10,000. After I've taken out the net assets, what the goodwill is 7,000. It means I have paid something in excess of, there's a value in excess of the assets the company has. The company asset is only 5,000. So why am I paying 10,000? And even in that 10,000, I do not have the full. Okay, you can see the Excel analysis. It's true. Let me stop my screen and show you. So, like I was saying, the purchase consideration we paid is 10,000. This is it. The NCI value is 2,000. So what it means is that the total amount the company is worth as per the valuation is 12,000. That's what it means. So the question will now be, why is the company worth 12,000 when, after I have looked at their books, I take their asset from their liability? What they have is 5,000. If they have only 5,000, why is the company worth 12,000? The company is worth 12,000 because the goodwill of the company is valued at 7. So that's why we say that goodwill is the excess you pay, the excess of the consideration over the net asset of the business. You know, by rights, you are mostly buying the asset of the business. I'm not looking at the question. This is just an assumption. I'm just assuming the 10,000 is imaginary, 2,000 is imaginary. I'm just saying. So I'm saying that whatever you pay for the business, you pay 10,000. The NCI is 2,000. Total value of the company is 12,000. But the net assets the company has is this amount. What I mean by the physical things you can see, when you take out the asset minus the liability, is what you have. Then the goodwill, therefore, is just 7,000. That's what we are saying. So goodwill is excess of what you pay for the company over the asset less the liability of it. That's the net asset. The net asset. So it's just like you want to buy a company. The company has one vehicle. The company has land. They have property. When you look at the value of the land plus all the property they have is 5,000. But the owner of the company is saying for you to buy only 70%, you need to pay 10,000. So what is the extra money that is added? It is the goodwill of the company. Maybe of the strategic location of the company, because the company has been in business over the years, the company has name. So you are paying for that extra things the company has. In a situation whereby your purchase consideration is less than the net asset list, what you have is called a gain on bargain purchase. Gain on bargain purchase. It is a situation whereby, let's say the asset is 15,000. So you see that your goodwill now is negative. Before now, they call it negative goodwill. But right now, we call it gain on bargain purchase. So it's simply that the purchase consideration is lower than the net assets of the company. So when you look at the company, let's say somebody wants to sell his business and the person has 2 cars. Those cars are worth 5 million. He has a building. The building is worth 5 million. That's 15 million. The person is now asking you that I want you to have 70% of my company, but you are going to pay 10,000. In that case, what you are paying is less than the net asset of the company. By the time you put so you're having gain on bargain purchase or negative goodwill. Do you understand? So that's it. So we have looked at now in goodwill, we have purchase consideration. What are the different kinds of purchase consideration? In purchase, when we talk about purchase consideration, we are saying you can do cash. You can pay cash when you want to buy a company. You can do share exchange. You can do deferred payments. I'm using the word consideration in place of payments. It's the same thing. Deferred payment means you are going to pay in the future. Share exchange means, I have shares in my company. I'm going to exchange the shares I have in my company so that you will be a shareholder in my company. And then I'll buy yours. So a big company like, who knows, you know VFD Bank, for instance. Then let's say we have First Bank. So if First Bank wants to buy VFD, First Bank can say, okay, I'll give you 2 shares. If I give you 2 shares in my company, for every 2 shares I give you, I'm going to take 5 shares in your company. This is what we call share exchange. So it is 2 for every 5. So VFD will give First Bank 5. First Bank will give VFD 2. So First Bank will be a shareholder in VFD, and VFD will also be a shareholder in First Bank. That is share exchange. But because First Bank is more established to VFD, they are giving less number. So that's what we call share exchange. In some cases, you can say, I'll pay you cash of this amount, then I will exchange shares. And then I will pay you an amount in the future. That's deferred consideration. But you know that if I say I want to pay you an amount in the future, that amount will not have the same value today. So for that reason, where there is a deferred consideration, you have to bring in the present value into it to compute what the value of that purchase consideration will be. All of this is I'm saying, I'm just saying it. As we progress in our class, we would explain and then we'll see practical example of it. But I want you to get the picture of it. So you have to understand the group structure, which we have looked at. In understanding the group structure, be able to know the date of acquisition, the date of consolidation is important. We have to look at the net asset list of the subsidiary. We have to look at the goodwill. Very important. After you have looked at the goodwill, you need to understand what we call NCI. Number 4, we have non-controlling interest. By non-controlling interest, we are referring to NCI. So when I say NCI, we are talking about non-controlling interest. This is simply the subsidiary's value in the business. And how do you get the subsidiary's value in the business? Either you use fair value method and say, if you want to sell up your shares, you will sell it at around 10 million. That's fair value. Or you could also use proportionate method. The different method would can use fair value or proportionate. Proportionate is I would use your percentage and multiply it by the number of shares. That's more like proportionate. If my own share is value 50 million and I have 70%, your own share that is 30,000 will be 30%. I'll use that to calculate what will be your value. That's proportionate method. But if you're using fair value method, regardless of what the parent share is valued at, the subsidiary shares will be valued by the parent. The parents will just give an amount, a fair value adjustment. That, if you were to sell 30% shares you have, this is the amount you sell it. That's what we call fair value fair value. So your NCI is simply the value of the NCI. And how do you get the value of the NCI? Most times it is given in the questions. Sometimes you have to calculate it and add whatever post adjustments. We would explain that later. Then the last thing I want you to understand, which I call the big five, is the retained earnings. By the retained earnings, we are talking about the retained earnings of the parents. So in trying to calculate, these are the adjustments we need to make first before we start solving any group account. First, we need to understand the group structure, the net asset list, the goodwill, non-controlling interest, and the retained earnings. The retained earnings is, if I look at, let me stop sharing here. Let's go to the Excel. So in this Excel, you see in this question, we are giving the retained earnings. Look at retained earnings. The retained earnings of the parents is 21,240. You have the retained earnings of the subsidiary. But when we talk about the retained earnings of the parents, in trying to compute it, all you need to do is to pick the 2124, then add it with the parents with some adjustments you would have made, which we would have made in the question, the percentage of it. But in reality, what are you trying to add to the retained earnings? It's more like the profit, the additional profit that is coming to the parent for buying the subsidiary. That's what you're adding. So all those adjustments you do, for most of it, I've done some calculation, is more like what is the additional value that has come to the parent retained earnings for buying the subsidiary. And how would you know that? You would know by an increase, whatever increase you have in the net asset of the subsidiary, you will take the parent percentage and add it to the retained earnings. That is what is the new value of the retained earnings of the parents. So that is basically the 5 core things you must understand. As we progress, we will now start talking about the standard. Now, the reason why most of you will struggle if you don't change that thinking is that you don't read the standard, you don't read the question, you just solve. You just solve and you master questions. Do not master question. Have an understanding of the standard. Why are we eliminating this thing? Why are we removing unrealized profits? Why are we removing these purchases? Why are we removing these sales? It is because the standard said that any transaction between the parent and the subsidiary should be identified and eliminated in full. So anything, let's say in the questions, we now say that the parent sold goods worth 10,000 to the subsidiary. It means the parent sold, the subsidiary purchased. In sales, in your revenue, you remove that value. In your cost of sales or your direct cost, you would remove the purchases. Then any good that is left with either the parent or the subsidiary, depending on who is buying, you have to eliminate that extra or the excess profit from the inventory. So that's what we talk about unrealized profits. So that's basically the big five we need to have an understanding on. Somebody is asking me to explain gain on bargain purchase again. When we talk about gain on bargain purchase, your friend has a business. She's selling juice. She has the mixer. The mixer is worth 10,000. The place she used to stand and sell the juice is worth another 10,000. So the total amount of money is 20,000. 10,000 for the mixer, 10,000 for the place she stands to sell. You want to buy that thing from your friend. Your friend is not saying that it is 25,000. She will sell it to you to buy the business over. Or she would have 50%, she would have 40%, you will have 60%. But what you are going to pay is 20,000. That's what you will pay. So you're not asking her that, but the place you would still have 40%, right, from the business. And you still want me to pay 20,000 when everything, the place you are standing to sell, the mixer is 20,000. So you now, how come you are still having 40% of the shares after I have paid 20,000, which is equal to the net asset you have? That 40%, that NCI value the your friend is having is the goodwill. Your friend will now say, I have been selling here. I started the business. I know what I saw when I started the business. And in the time I have been here, people had known me. You're not going to be starting from the beginning. Once you take over from me, people would just buy from you naturally. That is goodwill. That is goodwill. So you are bringing in 20,000. The asset is worth 20,000, but you're not getting 100%. So which means the money you are bringing in is more than the net asset of the business. That's for goodwill. But let's say your friend, the stand is 10,000. She has paid for it. The mixer is 10,000. She's not telling you to bring 10,000 to buy the business. In that case, by the time you take that 10,000 and subtract the 20,000 from it, you have an extra 10,000. That is what we call gain on bargain purchase, which means the amount you spend to buy the business, the asset of the business is more valuable than the amount you spend. So you have gained. So if you decide not to do business, you just decide to sell the stand, sell the mixer, you have made profit. That's what gain on bargain purchase is. I do not intend to go into details. I just want you to understand this big five, understand it properly, look at the questions. In our next slide, this is the question we are going to solve. We'll calculate all of the big five. So somebody also asked that I should explain proportionate method and fair value method. For you to measure goodwill or to calculate goodwill, there are two methods that is important that you need to use. One is fair value. The word fair value is simply whatever is given in the question, but in reality, it's what is obtainable in the market. What is the value of these things? Supposing you want to sell the shares you have bought in the market, that's the fair value. But proportionate is your net asset list is 10,000, for instance. If the parent has 70% shares, it means that the parent has 7,000, while the subsidiary has 30,000 and 3,000. So you are using the percentage holding to distribute whatever you have in the business, not the fair value. Now, for Mike, I might not be able to explain deeply in it. When we look at questions, it will be more clear. But if I start explaining, it will be so theoretical that you will not get the full picture. But for now, just understand that we have two methods, which I will go in to explain better as we solve. I don't want it to be so theoretical that you will not understand what I'm saying. So let's go back again over it. Let's look at the few things from these questions we have. Let's see what we could solve. So, like we said, if we were to solve using that question as a sample, the group structure, we say it was 70-80. So we have unitarization as 70%, famous as 30% from that questions. So the date of acquisition from that question is 1st of May 2014. The date of consolidation is what from the question is 31st of October 2014. So the period in between these two is 6 months. So in English, we say it's a mid-year acquisition. It means that anytime you want to calculate things, you have to put that at the back of your mind, especially things that affect the profit and loss. You need to remember that it's a 6-month acquisition. Supposing I want to calculate the net asset of using these same questions, what do I need to do? First of all, let's calculate the net assets using this question. If you want to calculate the net asset, first of all, you need to get the items. Then you have to look at it at the date of acquisition. You look at the date of consolidation or the reporting date. Then you now have what we call post. So let's say the date of acquisition is A. The date of consolidation is B. Post acquisition would be B minus A. So that's it. Now, from this question that we have, let's stop sharing. Let me share my entire screen. From this question we have, the question says that Unitarization PLC is a successful business. The company acquires 60% of the equity shares. Look at the word equity share in Famous. Now let's go to the net asset part, equity. Here is the equity part. We are not taking this 6,000, we are not working with on the parent, working on the subsidiary list, right? So I'll come here and then under this place, you put equity. What they have here, they have equity share, or you can call it share capital, equity share, whatever you call it is fine. At the date of acquisition, it is 2,400. At the date of consolidation is 2,400. That's the solving. You have to look at it if it is in, they're all in millions. So let's put millions here. So we have that all in millions. Equity share. What's the next item we have? The next item we have there is the retained earnings. We'll take the retained earnings. What's the retained earnings as at the date of acquisition? This one is not the retained earnings. We are looking for detail at the date of acquisition, not the reporting date. So you go over the questions. Let's see. In the first, they said the shares of payment has nothing to do with the return. There is cash in transit, has nothing to do with the retained earnings. The non-controlling interests are valued at full fair value. You see that in this question, they have told you the value, the method they are using. it is not based on proportionate shares, it's based on full fair value by the parents. The fair value of the NCI in Famous PLC at the date of acquisition was this amount. There's no goodwill impairment. The fair value of Famous PLC assets were equal to their carrying amount at the date. That's another thing to look at. The 60% shares, that's another thing. In the post-acquisition period, Unitarization PLC bought goods from Famous PLC, amounting to this. Famous PLC has had a markup of this. Famous PLC trade receivable assumes. Now, in this question, what we have here is we have the written earning. Yeah, this part we have, this thing we have here is the written earning at the reporting date. Let's just put it there. We don't know the for the 3900 is the written earning at the reporting date, but we don't know what the written earnings was as at the date of acquisition. But what we know is that this is the profit that this guy had made for 1 year. This profit for 6 months, it is post. Another 6 months, it is before it was bought. Why did we say 6 is post? You know that the company was bought in May. So if the company was bought in May, June, July, August, September, October is 6 months. In that 6 months, whatever you have there is the post profit. Profit is usually added to your retained earnings to get the position for a year. So we can say that if we take 6 out of 12 of 180, the value we would have is the post-acquisition retained earnings. So that's what we would use to get what should have been in the post. Because we are doing more like work back. So if I say equal to 6 divided by 12 times 1,800, what it will give me would be the post-acquisition. So it means automatically that as at the date of reporting, this retained earning was 3,000. Now, at the end of your account, you know that you need to take the profits to your retained earnings for it to balance. So this 1.8 has been taken to add to this 3.9. But from that 1.8, it's only 900 that is post. So that is what we did here. 6 out of 12 times is the post. So this minus this will now give you this to have your retained earnings as at the date of acquisition. Remember that you are still working with the subsidiary in this case. The subsidiary. So that is just the retained earnings. Now, there are other workings we need to do. Workings relating to your fair value adjustments, and others, but I do not want to continue at this point. I want us to take some time, have the time to go over and read, especially for those of us that this is our first time. If I keep moving forward, I'm thinking I'll lose you along the line. I want these terms are new for a whole lot of you. For some of us, it's not new. We've done it before, and this is our second time. But look at it. The group structure is important. Net asset list, goodwill, non-controlling interest, retained earnings of the parents. All of these things put together is what we are looking at. So here, the net asset list, the other items would include. But when we come for our next class, which will be next Wednesday, I would go more on it. But for now, I would entertain questions or contributions relating to what we have done so far. So Taiwo, before I unmute, we are looking at the net, understand the subjects. You are looking at the net asset of the subsidiary, not net asset of the company. This part where we have unitarization, it has to do with the parent. The part where you have famous has to do with famous. So if you are picking 6,000, it means you are trying to calculate the net asset of the parent. What you're trying to calculate is the net asset of the subsidiary. That's why we pick the 2,400. I hope I've answered the question. All right, I'm opening a class for. I'll call you. You can raise your hand if you have questions or you have contributions. You can just. I'll call you. Then you can speak. Okay, I'll start with Babaj. No, Babajida has spoken today. Let me start with Emmanuel. After Emmanuel, then
Okay. Good evening, sir. Thank you very much for your time. So I have just a quick question, more like trying to understand.
go ahead. Yeah, I didn't get what you said. Go ahead and ask a question. Okay, I think we've lost Emmanuel. So
I was done with my question. I'm not sure if you had me.
okay, tell me, Emmanuel.
Okay. So I was asking. I was trying to get the explanation around working back the post acquisition to know what the pre acquisition would be, or is it acquisition or retained earnings, right? Trying to see
Yep,
what is the
yes.
retained earnings for the post and pre. I would like a quick explanation on that just to be sure.
All right. So you see, for retained earnings, especially this particular working back, it's always very confusing, but it shouldn't be confusing. Remember that this profit or loss account is for 12 months. For 12 months, it is 1,800. The assumption here is that if I take this 1,800 and divide it by 12, whatever I have is the amount the company gets every month. And this account is for 1 year because statement of profit or loss is usually for a year. In this account, they've not told us what the date of acquisitions retained earning is, but they've told us what the retained earning as at the reporting date is, which is the 39. So to be safe, we are saying that usually when you are preparing accounts, if I give you your TB to prepare an account, when you do your balance sheet, it will not balance. It is when you have done your profit or loss account, you take the profit and add to the retained earnings to get what the figure is, and that is when it will balance. So this 1,800, it's a balancing figure that have been added to this 3,900. From this 3,900, we want to now know the part that was made after the companies had come together. The company came together in May, and this profit that is being reported is it at October. Because we have assumed that the profit is the same per month, we now said, okay, if I take 6 out of the 12th month, and that value would have been what we made after we have come together. That is why I put it under the column of post and then minus it to get what would have been as at the date of purchase. This is not the only way of solving retained earnings. They can come in different fold. But anytime you have a situation where it's not a full year acquisition and you have your profit or loss account, this is how to go about it. I don't know if I'm clear enough on that.
All right. Thank you very much, sir. Well appreciated.
No. So, Chimamanda.
Good evening, sir. Thank you for the class. My question is, you were trying to explain retained earning, and there were some things you were mentioning that I didn't really get quite well. So I will
Okay.
really that you explain it very well. Then, though you said you don't want to go into it because I was one that asked in the chat box about explanation between the different like the difference calculation when you are trying to calculate the NCI, how you calculate the fair value. I understand that the fair value is the value as at the market time, or the value at which they buy it at the date of consolidation, date of acquisition. But the proportionate is what I don't really understand. Or if I'm wrong in both of them, just help me out, please.
So you see, when you calculate the net asset lease, you see this solving we are trying to calculate here. When you
Yes.
calculate it, you are going to have a value as at the date of acquisition. You are still going to have a value as at the date of consolidation. If you are using proportionate method, the NCI value will be 30% of whatever you get at the date of acquisition. The NCI value will not be given to you. You just take 30% of whatever the date of acquisition's net asset is. That is what will be the NCI value. But if you look at this question has told you what the value of NCI would be. So when you want to calculate your goodwill, this method has to do with goodwill calculation. When you want to calculate your goodwill in this case, by the time you put in your purchase consideration, you are going to take 3540, which is this value, as the value of NCI. But if it were to be using proportionate method, you would now take 30% of the net asset as a date of acquisition as your NCI. So you bring in your purchase consideration, 30% of the net asset at date of acquisition as your NCI, and then you now subtract the full NCI value to get your goodwill. That is how proportionate is different from full value. Full fair value is that you are giving the value. Proportionate, you take whatever asset it is there, a portion of it belongs to the NCI, a portion of it belongs to the subsidiary. So that's just it.
And the NCI, the net asset, we are subtracting it from the parent company, right?
No. The net asset of the subsidiary is what we are trying to calculate. When you calculate the one as at the date of acquisition is the one you use the percentage on.
Yes.
Now, in most cases, they will give you what the value of maybe the share value of the subsidiary is, what the share value of the parent is. But all of this is, like I said, I don't want to go deep into it. When we are deep in it, I would explain it better. Now I'm explaining it at a superficial level.
Okay, sir. Thank you very much, sir.
You're welcome. So is Isiaku. Ibrahim can go ahead if Isiaku is not on. If Ibrahim is not there, I think Oloyide can speak then.
Okay, good evening. Thank you very much.
Yeah, good evening.
All right. So please, I need a clarity as regards, the question you just answered now. So, but like you said, maybe because we have not handled the question, that is why I'm not really getting clarity, but I'm not sure. So as regards the fair value and proportionate, yes, and I believe these are two methods of measuring goodwill, if I'm not mistaken.
Yeah, you're not mistaken. It's fine. That's the
All right.
correct thing. So that's why I've
So,
said, that if you want to calculate goodwill, there is a step to calculating goodwill. Even here, I've explained the steps to you. I said you need to get the purchase consideration. After you have gotten the purchase consideration, you need to add the NCI value, right?
yes.
Now, in trying to get NCI value, is the NCI value we're talking about. If it's fair value, they will give it to you in the question. Fair value is simply the parent has looked at it that the value of the shares the subsidiary has is valued this amount in the market if the subsidiary were to sell it today. After you have gotten the fair value, you just deduct it from, you add them together. That's what we did here, and deduct the assets, the net assets of the subsidiary for me to get the value. But in the case of proportionate method, let's say the number of shares in that company is 10, is 10. If the parent has bought 7,000, automatically the parent has 70%. You take 70%, which is 7,000, as the value of the parent, which is the purchase consideration. Automatically, the remaining 30%, which is 3,000, becomes the value of the NCI. That's proportionate method.
Okay.
So I don't need to look at the additional statement to see what the value of the NCI would be if it is proportionate method. Once I have the value of the NCI, by the time I subtract the entire value of the shares the company has. The remaining part is the NCI value. That's what I'm trying to say.
Okay, all right. So very quickly, please, as regards the NCI, and is this method, did the message just explain, is it applicable to getting the subsidiary value as well? You know,
What? I didn't get your question, sorry.
so like you mentioned that we use the percentage they are holding to distribute their value, right?
Yes.
Fine. So looking at NCI now. So what are the method to use to get the subsidiary value under NCI?
Which means if you are calculating NCI, there is no particular method. All you need to
Okay.
do is
Okay.
whatever is the NCI value here. Look at this part under goodwill. You are going to
Yes.
bring it here. Then whatever is the post-acquisition adjustment, which you would have gotten when we are doing this net asset list or from the additional statement, you are going to take a percentage of that, let's say 30% of that, and add it to the non-controlling interest value, and that is what will be the NCI value.
NCI.
Then if you are calculating retained earnings, you pick the value of retained earnings. 70% of whatever adjustment will now be the retained earnings of the parent. But don't worry, by the time we do one question solve, you see how we are moving these things. It will be much easier. But because now I'm just saying it, you're imagining it, you might not get it in.
Exactly. I appreciate.
Somebody is asking that how do we know we are to calculate for the subsidiary? Is it stated in the question? Now look at the heading. I said that if you want to do adjustment for group account, you must calculate the group structure. You must know what the group structure is. You must calculate the net asset list. Look at the word net asset list of the subsidiary. That's how we know. It is not the code doesn't need to tell you that you need to do all of these workings, especially when you know you are going to do P&L and the balance sheet. Once you have done this adjustment first, that is when you now start solving the question. These are just really adjustments. So these adjustments are all important before you start calculating. So that's how you know. That's how you know. Net asset list of the subsidiary. When you get to this place, look at it, the retained earnings of the parent. In this case, what you'll be using from the question will be retained earnings of the parent, not the retained earnings of the subsidiary. Here you are talking about net asset list of the subsidiary. So it means the retained earnings you are talking about here is the retained earnings of the subsidiary. Because here you are going to use the retained earnings of the parent. So here you cannot use retained earnings of the parent. And everything you are using here is what relates to the subsidiary. I don't know if I have answered the question. Ibrahim, I thought Ibrahim has spoken. Enoch, you can ask. I think Ibrahim is just reading this and I'll lower it.
Good evening, sir.
Yeah, welcome, Enoch.
Yeah, thank you. I just need more clarification of elimination of intergroup balances.
Okay. The question what you have asked now, even if I explain it now, it won't be clear because we are not solving the questions. But wherever you are calculating group account, you have to imagine like you are doing how do they call it? AC 111 or ACC 111. When you start preparing accounts, in this question, they're giving you group accounts, they're giving you consolidated account and published account formats. Look at this. This profit or loss has revenue. Here you have cost of sales. In this cost of sales, in real life accounting, you have notes. In that note, it will show you what makes up the cost of sales. In your cost of sales, you have inventory. In your cost of sales, you have purchases. In your cost of sales, you have items there. But when we are solving questions here, you will see that when we are trying to eliminate intergroup transactions, let's say the subsidiary sold to the parents 10,000 naira worth of goods. It simply means the parents in their purchases will say, I bought goods worth 10,000. The subsidiary in their books will say, I sold goods worth 10,000. So if each of them are saying that, and you have added the revenue of the two people, you've added the cost of the two people, you have to eliminate that their sales and that their purchases in the lines that it is applicable. So which means in this question, for instance, let's assume, I don't want to look deep, let's assume that they sold 10,000 naira worth of goods to themselves. In revenue, the parent sold to subsidiary. In the revenue, the parent would have added that 10,000 as revenue. So I'll come to 51 and deduct 10,000 from it. In sales, in cost of sales, the subsidiary would have been saying, I bought goods worth 10,000. So we will come there and take it out. So that's what we're talking about, elimination. In our next classes and in our subsequent classes, we'll look at the detail of that. But I think that's the best way I can explain it now. I don't know if you got a little bit of clarity from that.
Yes, sir. Thank you, sir.
All right. If there is no other question, I'll be ending the class for today so you can prepare for your next class. We would solve questions, this particular question, so you can get it handy in our next class. This same question I've displayed today in the class. Thank you for your time. Have a great evening.
Thank you, sir.
All right.
Thank you.
Yes, I
Thank
will
you.
share the Excel sheet.
Thank you, sir.
Thank you,
All
sir.
right.
Good night, sir.
Good night. Who is that small accountant?
Thank you very much, sir.
All right.